All right, hello class. This is Professor Reynolds, and I'm going to be talking about translation in the Chapter 12 exercises. So just as a summary, you can see here that I've included some notes which are listed under translation. And you can see that what we're really doing here is that this is a foreign entity. Now, the foreign entity is going to operate given the local currency for the most part. But there is a functional currency, and example 12, or problem 12.6, is a situation where we are transferring it from one currency to another currency and from that currency to the US dollars. Really the same method, but here are, again, because there's no way to really comprehend if you have some items in dollars and some in foreign currency, your mind just can't really reconcile that because you don't really have experience with other currencies. So we have to convert everything to dollars. All right, so how do we do that? Well, you can see here all assets and liabilities are transferred from the local currency into the reporting currency using the current exchange rate, the spot rate. Paid in capital accounts use the historical rate, depending upon the type of or the way this is handled. In a purchase transaction, the accounts are transferred using the historical rate on the date of acquisition. So the date that we acquire the company is the date that we're going to use as far as the paid in capital accounts. Dividends are translated into dollars using the exchange rate in effect when the dividend was declared, because that's when dividend became an obligation. Revenue expense accounts, appropriate average, you really should use what's on that day, but we're going to assume that we have similar or even transactions throughout the year. The translation adjustment is a balancing amount that reconciles the total debit balances with the total credit balances after all the individual accounts have been translated. So there'll be a difference, and that is the translation adjustment. And then you have the temporal method, which is used in a high inflationary economy. All right, so this is 12.4, and this is really just basically on January 1st, 2024, Monty Systems, a US-based company, purchased a controlling interest in Blossom Management. Consultants located in Zurich, Switzerland, or management consultants located in Zurich, Switzerland. The acquisition was treated as a purchase transaction. So now we can see the dates on the date of the acquisition and then on the year end. So we're going to use some of this, like the common stock, and we're going to translate that using the interest rate in effect, or the rate in effect at that time. All right, so we have revenue and operating expenses, and we're going to convert that on the average for the year. And it's simply multiplying the revenues by this factor. So for US dollars, there's 1 Swiss franc is equal to 1.06 US dollars. So all you do is multiply these two numbers together. You multiply the operating expenses together, and then you get the net income of 45,792 in dollars. And then you do the retained earnings, which again is 11,000. That's what was true at the beginning. Dividends would be on the dividend declaration date, dividend date. So that's 14,900. And so I'm going to subtract that. I'm going to add this, subtract that. And so we're going to get, okay, so the net income minus the dividends here, plus the beginning retained earnings. All right, so here is the consolidated income and retained earnings statement here, which is really pretty much what we just went through, but in a different way. Okay, so here we're going to have total retained earnings minus the dividend declared. But we get the same number, 41,690. Again, all we're doing is multiplying the 6 Swiss francs times this factor, and that's going to give us the dollars. And then for the balance sheet, of course, 1.03 That is the spot rate that existed on that date. So we're going to translate that. Same thing with the net property, plant, and equipment. Same thing with AP and net payables. Common stock, again, we're going to translate that when we acquired it, and we acquired it on January 1st. So that's where we get the 109. And then the cumulative translation adjustment is going to equal the totals in assets minus the totals in retained earnings, and that's going to be the cumulative translation adjustment, and that will go to other comprehensive income. And then B, of course, we're going to look at the assets and liabilities. Assets, liabilities, equity, we're going to get B9 minus B10. All right, so B9, which is the total assets minus the total liabilities, and that's going to get the exposed net asset position. And again, because we're in the beginning of the year, that's the factor we use there. Adjustment for change in net asset positions during the year. Net income would be, again, the average rate. So 1.06. Dividends, dividend declaration date, and that's going to be a negative. So we add these together, the exposed net asset position on 1.1, which again is why we use the 109. The net income, which is the average for the year. The dividends, it's the dividend declaration date, that's 1692. So the net asset position translated using rate and effect at date of transactions is 63. Exposed net asset position on 12/31. Okay, so that's going to be 58 times 1203, which is the date on 12/31. And then that agrees to the cumulative translation adjustment. And you can use this on tab 12.6. I did a different way, but exercise 12.6 is similar, but what we're going to do is you have a US-based company located in Zurich, Switzerland. But for some reason, we are going to remeasure these accounts balances that are expressed in Swiss francs into Brazilian reals. Not sure why we're doing that, but that apparently is the currency that we should be using. So again, you have the same issues here. You have the beginning of the year franc, real per franc. You have the end of the year. You have the average for the year, and you have the dividend payment. All right. And so you go through the same, but this translation loss, again, what I've had to do is I've computed this without the translation loss. And so what you get here is you're going to get retained earnings of 53,491. All right. Or I'm sorry, you're going to get all your assets, okay, from this column, and that is 121,243. You're going to do the same thing to your AP, your liabilities, and your common stock, and your retained earnings before this adjustment. Okay, and so you get 123,432, and you subtract these amounts, and that's going to be your translation adjustment. And you could probably do this to get to that figure as well. So I just basically copied, you see that equals that, those equal. That doesn't equal because we don't have this translation loss here. So that's going to change these. So retained earnings ends up being 53491. And so that allows you to determine what this translation loss is going to be. But again, it's the same thing. Here, you're going to translate the revenues, expenses at the average. So what's different here is that then we're going to go and translate those dollars to real. All right, and let's see what this, see if these amounts are the same. It is. So we first translated it into real from Swiss francs, and then we're going to, or we measured it into Brazilian reals. And now we're going to translate it into dollars. All right. And so our totals are 56,136. Let's look at here. So it's actually a little different. You can see here that the, let me look at this again. So the totals for cash and receivables into dollars has changed. You wouldn't think that that would happen, but it does. But again, you go through the same process. You identify, well, what is it? Revenue, expenses. So that's the average rate for the year. You do that for operating expenses, other, and then the translation loss again is 2189 Swiss francs or reals, which becomes $1,040. All right. And you can see that totals equal. So this is just a two-step process versus the one-step process. And so that's really the translation adjustment. It's not difficult. It's just, a lot of calculations, and it's also determining which rate is the correct rate.